All right, guys, welcome to this week's episode of the WealthLab Podcast with Phil and Scott. Phil, how are you doing today?
Good, thanks, mate. How are you?
I am well. We are going to crack straight into it. So we're going to talk interest rates. It's the thing that everyone's talking about. It's the topic of conversation. So I think I'm going to weigh into this on my end because I know from a financial planning perspective, we should be talking to people about it, and we certainly should have an understanding about it. So that's why I'm going to throw it out here right now. Now, for those people that don't know me, I do have an economics degree, and it was done 17 years ago. That's when I first started studying. So kind of depressing to think about that. And economics is an economics degree is almost as useful as reading horoscopes. It is absolutely useless, in my opinion, of predicting anything that's going to happen in the future. But it's brilliant for looking very clever when you look back on data. Because of course, this supply and demand thing happened over here. Because of course, this war over here caused this. So, for example, during the last year's Ukraine war, with the Russian sanctions that were put in place, you would have expected the Russian currency to devalue significantly because the Americans basically blocked them out of the SWIFT network, which is the global payments and transacting network. Well, what's happened today is the Russian ruble is worth more than it was before the war. Who would have thought? Supply and demand's a funny thing. Anyway, what I'm going to do is I'm going to put my take on interest rates because I believe very strongly about this, and I think it's something that's valuable for our upcoming clients and our existing clients. So let's just crack in here. If you have a mortgage, if you have a home loan, if you have an investment loan, if you have a car loan, if you have a credit card, this is related to you. Now, very simple here. What we've got is Australian cash rate over time. The left-hand side, we've got the rates, and then along the bottom axes, we've got time. So this chart that I have in front of me starts in the year 2000 and finishes approximately on I think it was Wednesday's or Tuesday's most recent rate rise. So what does it look like? Well, historically, over the past, say, 23 years, rates would have been somewhere, we'll just call it, say, 4%, which is kind of a middle rate. And when we say cash rate, that's what that is the base rate. If you're going to be getting a mortgage or a home loan, you probably add 3% on top of that. If you're going for an investment loan, you probably add 4 or 5% on top of that. If you're going for a car loan, add 6%. If you're adding for a credit card, add 15%. So this is just this base rate does move up and down, but the margin the banks put on their products is pretty much fixed. So for example, it does move up and down a little bit, but not very much. Now, what we're going to be doing is we're just looking at how the Australian rates have dramatically moved up. And there's a lot of talk around Philip Lowe or how the RBA have really stuffed this up. My perspective on this is that the RBA actually shouldn't even exist. The RBA doesn't actually do anything of any value because have a look at this chart. What's this? This chart is the chart of the Canadian interest rates. The left-hand side has got the interest rates, and along the bottom axes, it's got the changes. This chart, for those who are listening, looks exactly the same as the Australian chart. No difference. So why is it that a country in a completely different hemisphere with a completely different set of principles has a lockstep chart on interest rates with Australia? No difference. They follow each other exactly. Look at that. Well, have a look at this. This is the final one. The final chart here, as I'm showing, is the US rates. So the US rates are what drives global interest rates. So there is effectively no point looking at what the RBA minutes are talking about in terms of microeconomic policies around what's happening in Queensland or South Australia or Victoria. What happens here is the US drives global interest rates. So if US rates are going up, our rates are going up, and vice versa. So, for example, the US rates kicked up 2 days ago, up, and their cash rates are getting close to 5%, whilst the Aussie rate is only at 3.85%. So there's a fairly big difference between what the base rates in the US are at versus what they are in Aussie. Now, during COVID, the US rates were almost the same as Aussie, So we had the same starting point, but what they've done is they've gone harder than we have, and they have been trying to control the same inflation issues that we've had. They've had the same issues with builders going under, with supply chain constraints, as well as with labor shortages. So going forwards, if you're worried about what's going on with Sky News or ABC News, or updating on what's happening with the whatever's happening in the news, my opinion is it's not even worth looking at, because the only thing that matters is what's happening in the US with their rates, because we will be following that. So if they're up, our rates will be up. If they're down, our rates will be down. And that's basically it. That's really, in my opinion, all that you need to know. You shouldn't be stressing over what minutes are going to be released if you're worried about your mortgage. The US rates have gone up, and they've gone up harder than ours have. I suspect we're going to be following them. So on that note, Phil, over to you. Let's talk interest rates.
Doom and gloom, mate. So yeah, I mean, when following that logic, it's probably likely we'll see possibly some further interest rate increases. I know you've just said don't go and read the RBA minutes, but obviously I've looked at some. And there's a few.
What do they say?
Well, I think there's a couple of interesting points in there when it just comes down to the average mum and dad sitting at home that doesn't care about all the economics stuff and just cares about what they can afford to buy and put food on the table and all that sort of gear. So one of those things is that there's, they're calling it a fixed rate cliff, but there's a whole ton of these loans that are about to come off really low fixed rates, stuff starting with 2%, that are about to drop off and come off at something probably, maybe north of 6, high fives, low sixes. So that's going to be a huge impact to a lot of families as those fixed rates start to come off. And further to that, I was just looking earlier that they reckon about 15% of those people are not going to be in a position to be able to refinance their loan. So they're effectively trapped.
So why is that?
Yeah, so look, one of the big things a bank looks at when you're applying for a mortgage is your ability to service that mortgage. Makes sense, yeah? They're not going to lend you money if you can't afford to pay it back. So when they're assessing you, they're not looking at what the rates are today. They actually apply a buffer to that. So you've got two issues. A, your original loan was approved at a much lower rate, maybe 2%, something like that. So your borrowing capacity was bigger then. We've had all these rate increases, and every one of those rate increases has reduced your borrowing capacity because now it costs you more to service that loan. And compounding that, APRA came out, which is like a regulator for the banks, and they came out and suggested the banks need to increase the amount above their rates that they test you on when they're looking at your servicing. So if a bank's rate's 6%, they're actually assessing you on, somewhere around 8.5% to 9% interest rates. So every rate increase is reducing your borrowing power. So if you're someone that, maybe only just scraped through for your servicing on a 2% rate back when you took that loan out, when that drops off at 6% and you try and reborrow, you're likely in a position, or you may be in a position, depending on how much you've paid off, that you can no longer service that size of a loan if the interest rates were there.
Can you say that, but can you say that again slightly slower, please?
Sure.
I want to get my head around this, because I'm doing is I'm trying to find, is there a serviceability ratio that we can find?
Yes, there would be. I'm sure of it.
Anyway, so tell me this again. So as every rate rises, that goes up. Yep. How does it impact? So just say again.
Yep. So if an interest rate increases, the cost to service that loan increase, because now every repayment that you're making is paying a higher percentage of interest or a higher amount of interest, but you've still only got the same amount of time to pay your loan back. So you need to make a higher payment every fortnight, month, whatever, to meet that obligation. So when a bank's looking at what you can afford, the amount that you can now afford to borrow is less because more of every repayment is going towards covering interest.
Yeah, okay, that makes sense.
That makes sense. And then to compound that further, the banks used to use a rate of sort of 2%, it's gone to 2.5% above whatever their rate is when they're looking at your servicing ability. So when they're assessing you for your ability to repay that loan, if their interest rate was 4%, they would assess you at 6%. Now, if it's 4%, they're assessing you at 7%. So it's further reduced the amount of money you can borrow because of this serviceability buffer that they need to have. So hopefully I've explained that in a way that makes sense.
So roughly, so when they say what's their opinion on what they think that I can afford versus what I know I can afford? So what does that mean?
Yeah, I mean, what you can afford is largely irrelevant, right?
Really? Why?
Well, yeah. Well, I mean, you can come to me and tell me that you can afford to repay whatever. You're just going to tell me whatever you need to tell me to go and get the loan.
Okay.
Possibly, maybe. So what the banks are going to do, and this is where you sort of start to talk through some steps that you might be able to take if you're potentially going to be looking at refinancing, you're coming off a fixed rate, and you know that you're going to get kicked in the teeth when that happens. So maybe you start to think about, can I refinance when that happens? Banks are typically going to want to see 3 months bank statements, maybe 6 months, depending on the lender.
Okay.
And they're going to go through.
So if I have like a bunch of different bank accounts, what do you reckon about that?
Yeah, well, if you're a honest, straight up and down person, then you're going to make sure that the bank knows about all your bank accounts and you're going to provide the statements for them. But typically, they're going to want to see your main transaction account at an absolute minimum.
Mhm.
And what they're looking for is obviously stability of income. So what have you got coming in versus what have you got going out? And they will use that to work out what your cost of living is, regardless of what you've told them.
Really? So
Yes.
is this the HEM? Is that what it's referred to?
The HEM, I've not even heard that term, so far away.
I think it stands for the home. Oh my God, it's the rate that they assess people on, what they assume your spending is.
Yeah, so they do have minimums that they'll adhere to. Regardless of what everything else says, there are minimums that they'll have.
Yeah.
But
Household expenditure measure.
There you go. The HEM.
So
I like it.
yeah, so what the banks do is they have a guide to HEM living expenses. So if you Google this yourselves, you guys can have a look. It's a clear measure that the A bank will use when assessing you, and they'll basically just go. There's sort of 3 basic, moderate, and lavish levels, and they'll go right for a family looking at buying in this postcode. And it's usually postcode specific. They will then look at what you're going to be spending, what they think you spend as an average household with, say, 2 kids, a car loan, and a 25% deposit on the property, what they think you're going to spend on a monthly basis, and they're going to assess you on a HEM basis, which is, we think you're going to be spending $12,000 a month if you're living in North Sydney, or say, for example, $8,000 a month if you're, say, Darwin. And yeah, so that's the dollar amount. So what you actually put down as your expenses, they'll look at it and they'll consider it and then probably ignore it and go at a higher amount.
And if your bank statement tells a different story, it could be a higher amount again.
So what are problems with the bank statements that people happen?
Now,
to be clear, this is 2 financial planners talking about mortgage broking. Now we should have now we're going to get hit up with every mortgage broker there is coming at us, right? So don't come at us, boys.
No,
or girls. Don't do it. Right. What we want to say is just, here's some things that, as a podcast listener, that you should be preparing yourself if you are coming up to a refinance or considering refinancing.
Yep, good call. So the first thing I think is just keep that in mind, right? They're going to want to look at the minimum last 3 months bank statements. So go through those statements and think about what's on there. And if you were sitting there deciding whether or not to lend money to someone, how would you be viewing those things? So there's a lot of stuff you're not going to have control over, your school fees, childcare, food at the shops, rent, whatever, mortgage, whatever you're paying. Like, there's a lot of fixed expenses you're not going to be able to do anything about. But think about those discretionary expenditure, how many times you're going out for dinner, how much, how often you're hitting KFC, gambling, you're throwing money to one of the betting sites every weekend for a couple of bets on the footy, those kind of things. They are expenses that you can remove, that you can, if that's something you love doing, don't do it for 3 months. You know what I mean? That's the sort of stuff that you can control. It's on your bank statement that could reduce your accessible living expenses. Afterpay, we've spoken about this before, but things like Afterpay, you kind of, buy now, pay later type stuff, not necessarily going to be make or break for a loan application. But if there's a clear pattern there, you're someone that's using Afterpay to pay for your groceries or something like that, or you're paying your Afterpay bill with your credit card, or it's clear that there's a pattern there because you're not meeting your living expenses and you're having to use these buy now, pay later providers for day-to-day living, that's going to raise some red flags.
Right. So Phil, how do I if I want to put $500 into my Sportsbet account, how do I do it? What's the best way? How can I do it without it showing up on a bank account statement?
Don't do it. I mean, life's a game of trade-offs, right? So, right, what do you want more? Do you want to have a quick $500 punt, or do you want to buy the new house or refinance your loan? Make a decision and go with it. I'm not saying you can't do it. I'm just saying beware of the consequences. make an informed decision. The other things,
he's ruthless. His
yeah.
ruthless friends.
I need to be that ruthless with myself. But anyway, that's a different story.
Go back to the. We promised we weren't going to talk budgets this week. So
yeah, I'm not.
Let's stay away from that.
This isn't budgeting. This is being mindful of what's on your bank statement. Other stuff to think about, separate to that, credit applications. So, Afterpay stuff they don't run a credit check. So it's not going to show on your application, but, payday loans, personal loans, other types of finance you're applying for are going to show on your credit file. And if you've got a pattern of like a heap of rejected credit applications or a regular pattern of credit applications and certain types of credit, like, some will be worse than others, things like payday loans and that sort of stuff, banks are going to hate seeing that. So that's something else. Don't go and, have 15 goes getting a personal loan, before you want to try and refinance your mortgage. That's going to raise alarm bells. So that's something else to think about. Credit card limits is another one. So a lot of people don't think about this one. When a bank's assessing your credit card, they're not looking at what you owe. You could have a zero balance. They don't care. They're going to look at what's the limit available on that card, and they're going to assess your monthly commitment for that at 3% of whatever that limit is. Do you need a 20 grand limit? Can you get by with a $1,000 limit? Whatever. It's going to be different for individual circumstances, but it's something to think about. They're going to assess you on the limit, not the balance owing.
What about my crypto punting account? Is that going to show up?
Well, yeah, probably. If you're funding it from your bank account, it probably will.
Okay. So, guys, the summary from this meeting, from this call, is that organize yourself for basically you want to make yourself as credit ready as possible. You ensure that you've got tell your partner, if you are looking at doing a refinance in the future, you probably would be, or you probably should be, because the banks treat their existing customers badly. So you really should always be ready to move. The final one on that the final 2 points is tell your partner what you've just listened. So not everyone's going to sit down and listen to a 20-minute podcast from two financial planners, but well done, you've come this far. Tell your partner. Summary is that, look, if we want to refinance, we need to make sure that our accounts are in as pristine shape as possible. So let's polish that up. What that means is paying off any afterpay, looking at the credit card limits, looking at the punting limits.
Yep.
Generally ensuring that our salaries are going into the same account, so it's easy to see it coming in, or just basically like closing any random bank accounts that you don't need. Yep. And the final one is the Credit Savvy app. Now, this is a Barefoot Investor suggestion as well. Credit Savvy, this is an app that will show you basically what your credit limit is. Sorry, what your
credit score.
Credit score, and it's going to give you like, I don't know, this is my one. It's going to give you basically like a radius on how accessible you are, and that's a great thing just for your own information. Now, the bank won't give us give us stuff; they will do their own thing, but that's just a good for your understanding as well, because it will do it, and this won't ping your credit file. So that's a good little app to hang on to. So, with that in mind, anything else, Phil, that we should add in?
Mate, probably just one other one is just be really careful of like overdrawings and stuff on your accounts, and make sure you know when your bills are due to come out, direct debits are due to come out. Make sure the money's there, because that's another one that's going to hurt you. If you come in, you got 3 months full of overdrawings on your account, that's going to hurt too. So, something else to think about. Yeah, just a few tips. Look, we can't work miracles, but these are just things about presenting yourself in the best light to a potential lender.
Love it.
If you're one of our clients and you're in that boat, reach out to Scott or I. We do, I'm sure we can refer you to someone that we know does a good job. Don't pay the lazy man's tax at the bank.
Also, where we sit, we like to refer in the same way that people refer to us. We do have a suite of brokers that we work with on the insurance as well as the home loan side, and I like to match people with on personality as well, just so you click, because you give your broker literally everything. You say, here's my intimate bank account details, and then you trust they'll then take them and then show them to a credit analyst and then get you a new loan. So you actually clicking is a really important aspect of not just trying to find the best rate, because if you don't click, it doesn't tend to work.
Yeah, agreed.
Cool. All right. Thanks, guys. Thanks for listening. Phil?
Yeah, thanks very much. Cheers, you too. Thanks, guys.